The stock market is a complex, ever-changing digital place. Sometimes it is really nice to you, and sometimes it bites you in the butt. The stock market revolves around the trading of shares. A share is a very small part of a company that the company trades for money. So let's use a pretend company as an example. Cakes R Us. Cakes R Us is doing good, selling a bunch of birthday cakes and wedding cakes and all kinds of cakes. The owners of Cakes R Us think they are doing so good they can open another store, just like the one they already have across town, and own two stores, hoping they can double their money that they have coming in. Twice the stores means twice the cakes being sold, which means twice the money, in theory. In order to get some extra money to open the second store, Cakes R Us starts to sell little pieces of their company to the public in exchange for money. These little pieces of the company are called stock. The public and the people see that Cakes R Us are starting to sell some stock, and the people see that Cakes R Us are doing good, so more people want to buy the stocks, making each share more expensive. Now remember, each piece of stock is called a share, since you are sharing small amounts of ownership with the company. Each person that owns a share is called a shareholder. As more people buy stock in this company, Cakes R Us is building their money until they finally have enough money to open the second store. When they open the second Cakes R Us, more cakes are being sold, so the stock continues to gain value because Cakes R Us is making more money. This makes the shareholders money as well. The trick to making the most money off of the stock market is to sell your share at the right time. So you see that Cakes R Us is doing really, really good and selling a whole lot of cakes, and your share is worth a lot of money now. But you think Cakes R Us is about to hit a roadblock and business is about to go downhill. You sell your share for, let's say, $75, but you bought it in the beginning for only $25. You made $50 off of your share of Cakes R Us. Let's pretend you had held on to your share, and Cakes R Us did have a long period of bad business where they weren't making money. Then that $75 would have decreased in value. If the value of the share starts to go down, then most shareholders with that company try and sell off or get rid of their share as quickly as possible. If the business is doing bad and everyone is trying to sell their share, the value of each share goes down very fast. Your $75 share could drop in value so much it becomes worth only $10. If you try and sell it when it's only worth $10, then you have lost $15 because you paid $25 for it in the first place. On the opposite side, if you sell the share at $75 and make your $50, but the value of each share is continuing to go up and ends up being worth $125, then you missed out on $50 extra. The value of each share in each stock in each company is always changing. The value of each share goes up and down daily, and the stock market can change in as little as a few minutes. It is really just a gambling game, and a game of chance when it comes to the stock market. You are rolling the dice and hoping for the best every time you participate.